First, we have a forecast horizon, and that forecast horizon is 2008 to 2011. Now, I actually would have, and down here we have the growth rates for 2008 to 2000, assumption growth rates for 2008 to 2011. Just as a way of criticism of this, I would probably have done a longer forecast horizon so that it's a little bit smoother transition of the growth rates. But this is for visual effects, this works a little bit better. And then the assumption of steady state growth is equal to 6%. And then we assume that cost of goods sold, okay, and SG&A are 45%, pretty much 43 to 45% from 2008 to 2011. And in steady state, we assume that it is 45. And then we go SG&A as sales is 33, and we have all these other assumptions. Now, if we go back down here, so if we take a terminal value, we calculate a terminal value, which we'd want to have here, we would take our 489 divided by our weighted average cost of capital, weighted average cost of capital, minus our assumed growth rate, which in this case we have a WACC of 10.96, minus 6%, and we wind up with a terminal value which is, I think it's 9860. We'll go down a little bit more, 9860, which is equal to 9860. Okay, so that would be our terminal value, and this would go right there. Okay, now, and when we do that, we take all these free cash flows, and down here in the model they differentiate it, and they say, okay, the terminal value is 9860, and we take the present value of that at the weighted average cost of capital and get 6504. And basically the present value of this is the free cash flows from 2008 to 2011. That's just the present value of the free cash flows. And we wind up with an enterprise value. All right. This is the enterprise value of 7154 because they're assuming that this is an all-equity firm. And there's a little bit of debt there, but almost no, it's basically an all-equity firm. Take the shares outstanding and wind up with a price per share of 84.17. Okay, and so I put the 84.17 up here, and that's the estimate. Now, a couple things. Let's go back to and let's focus on two things. First, this implies, okay, do these margins, these cost of goods sold and SG&A, do they represent a situation where there's a competitive advantage? Let's go back over here to Exhibit 4. In this particular case, what we see is COGS to cost of goods sold for everybody else is almost, for these, even these growth firms, it's like 55%. And that SG&A to sales is like 33%. So go back over to 6. So we're assuming a rather substantial competitive advantage in terms of margins by assuming the cost of goods sold is 45%, okay, and sort of winds up with these high margins. And especially in steady state, we're continuing the assumption about having a competitive advantage of 45% of the margins. So in order to go back over here, and so if we look at Exhibit 4, more likely that certainly in steady state, the margins are going to look a lot more like 55% and not 45%. What happens then when I change this to 55%? The stock price drops to $45. So if I assume that, okay, it drops down to steady state at that in steady state we get a set of margins which are much more like what we see in the other firms, the price for this should be around $45.08, not $87. So, and if we sort of think about it, so we could also go over here and say, well, how realistic is some of these assumptions about the growth for the first 4 years? There's a very significant growth. And I could go in here and also say cost of goods sold as a percentage of sales. This isn't going to go from 45% to 55%, and the growth rate. But as I said before, if I sort of start changing the growth rate, how much difference does it make? If we're pretty much in steady state, and that is the margin that matters. So if I made this 0.04, stock price goes from 45 to 35, and if I made this 0.08, it winds up going from 45 to 65, which is pretty much a big swing. And if I wanted to try and be more specific and sort of said, well, it might be 0.57, and this winds up being 0.06, and this is 0.04. We don't quite get exactly the same swings we get when we put in 0.45. If we put in 0.5, we wind up with that. But then if we put in 0.08 as a growth rate, we get this huge increase in value. So I think a case can be made here in thinking about this, that one of the things that should be reasonable for Crocs is that they have a margin in steady state which is more consistent with some of the other margins of some of these other firms. And if we look at what the growth rate's been, we would sort of could adjust the growth rate. So in doing this, what I wanted you to do in your exam, I'll look at those, what you handed in, is basically to recognize that that growth has an impact on value. And that specifically that in steady state, we have to look at things like margins, and margins specifically, making sure that they reflect the fact that there is no competitive advantage in steady state. And we would do that by sort of, well, what are the margins for firms that are sort of in the same space but have a much more mature basis for making a forecast. All right, so the key here is really on this particular thing was focusing on the growth rates and focusing in on what the margins would be in steady state. So what I would do, I'll go back over this on Tuesday. On Tuesday night, we'll look through all of this, and I'll report back what assumptions people made and what they think should be the appropriate stock price for Crocs. Thanks, and I'll see you on Tuesday night.